Wall Street just watched silver trade $40 billion in a single day, and most analysts are calling it healthy consolidation. Here's what they're not telling you. That volume exceeds the entire first quarter of last year. The crowd just showed up. And when retail starts screaming about triple-digit silver on Reddit and TikTok, you're either watching the birth of a supercycle or standing at the edge of a trapdoor. The difference comes down to one signal that separates sustainable breakouts from spectacular wipeouts. Stay with me because there's one signal hiding in plain sight that could decide everything. This is the boring currency, and today is January 28th, 2026. Silver just touched $106 after flirting with $113 intraday, and the market psychology has shifted from cautious optimism to full-blown FOMO in less than 72 hours. Today, I'm going to do two things. First, I'm breaking down what's happening right now in the silver market. The mechanics behind this parabolic move, the volume signatures, and the physical market signals that most YouTube channels won't discuss because they require actual research. Second, I'm connecting this price action to the bigger macro setup and telling you exactly what comes next, with specific price targets and timelines based on historical precedent and current market structure. If you get value here, hit subscribe. It helps more than you think. This channel exists because people like you share it, comment, and engage. We're building something different here. No clickbait thumbnails with fake shocked faces, no pump and dump garbage, just cold, hard market mechanics. This is not about headlines, this is about mechanics, because when silver moves 15% in 2 days and dealers start refusing physical inventory above certain price levels, you're watching liquidity dynamics that most traders don't understand until after they've been liquidated. The stakes? Whether you're positioned for a generational wealth transfer or about to give back 6 months of gains in 6 days. Now, let's talk about what's actually happening in the silver market, because the surface story and the structural story are two completely different things. Silver closed at $106.37, up 2% on the session. That sounds calm, right? Boring even. But here's what that number hides. An intraday high of $113, a failed attempt to challenge yesterday's peak of $118, and volume characteristics that scream terminal phase behavior. The SLV ETF, the largest physically backed silver ETF in the world, traded 15 times its normal volume. Let me say that again with emphasis. 15x. We're talking about $40 billion changing hands in a single trading session. To put that in perspective, the entire first quarter of last year saw $35 billion in total SLV trading volume. One day just exceeded 3 months of activity. When you see that kind of expansion, you're watching one of two things. Either institutional money is repositioning for a multi-year bull market, or retail is arriving late to a party that's about to end. The challenge? Both scenarios look identical in the moment. Here's where the mechanics get interesting. Silver's showing what I call meme asset behavior, 3 to 10% daily moves that feel more like crypto than a precious metal. That's not inherently bearish. Gold in 1979 had daily moves that made Bitcoin look stable, but it is a warning sign about sustainability. Markets that move this violently need consolidation periods to build the structural support for the next leg up. Without that consolidation, you get a round trip back to the starting point faster than you can say stop loss. The key technical levels right now: support at $106, which has held so far. Resistance at $110, which needs to be reclaimed to trigger renewed FOMO and bring in the next wave of momentum traders. Above that, $118 is the line in the sand. Yesterday's high that represents the battle zone between bulls who think this is just getting started and bears who see a classic blow off top. Now here's the first cliffhanger. Short interest in SLV has basically disappeared. The bears have capitulated. And in market mechanics, when everyone's on the same side of the boat, that boat tends to tip over. The question is, which direction it tips? Through $120 into a full mania phase, or back through $100 as late arriving retail gets flushed out? The answer is hiding in the physical market, and that's where most analysts stop looking. Now let's talk about the supply side, because this is where people get lazy and start repeating talking points instead of analyzing actual market structure. Silver mining has a cost floor around $30 per ounce. Think of that as gravity. Over a 5 to 10 year horizon, prices tend to orbit around production cost with periodic spikes above and crashes below. We're currently at $106. That's a 250% premium over mining costs. Does that mean silver's overvalued? Not necessarily. It means the market is pricing in something other than just supply and demand equilibrium. It's pricing in fear, momentum, speculation, or genuine shortage. The trick is figuring out which one. Here's the supply constraint nobody's talking about. This isn't 2011 where mines could ramp production in response to price signals. We've had a decade of underinvestment in primary silver mines. Most silver comes as a byproduct of copper, lead, and zinc mining. When silver prices spike, but base metal prices don't follow, you can't just turn on more silver production. It's locked to the production cycle of other metals. That creates a genuine supply bottleneck that can persist for years, not months. On the demand side, you've got three forces converging: industrial use for solar panels and electronics, investment demand from people trying to escape monetary instability, and, this is critical, a physical shortage developing in certain delivery channels. Reports are coming in that some dealers are not buying physical silver above $100 per ounce. Why would a dealer refuse inventory in a rising market? Two reasons. First, volatility risk. When an asset moves 10% intraday, dealers get stuck with inventory that could be underwater by the time they find a buyer. Second, and this is more concerning, liquidity fears. If dealers think the paper price is disconnecting from the physical market, they don't want to be left holding inventory they can't move when the music stops. Think of this like a leaky bucket on a treadmill. Supply is the water coming in. Constrained, slow, can't adjust quickly. Demand is the treadmill speed, accelerating fast. The bucket's leaking because some dealers are pulling back from the physical market. And everyone's watching the water level, wondering if it's about to overflow into a full mania, or if the treadmill's about to stop and dump the whole thing on the floor. Comment what time you're watching this right now. I read those. I want to know if you're watching this at 3 a.m. because you're nervous about your position, or if you're checking in during your lunch break to stay informed. The timestamp matters because it tells me what kind of market anxiety we're dealing with. The math here creates a setup where small changes in demand can produce violent price moves. That's what justifies a price target above where we are now. But it also means the path is going to be chaotic, not smooth. Now, quick history lesson, because cycles rhyme, they don't repeat. And if you don't understand what happened in past silver spikes, you're going to make expensive mistakes in this one. 1980. Silver hit $50 on the Hunt brothers' attempted corner. That wasn't a market. It was a manipulation that ended in a regulatory crackdown and a crash that took 2 decades to recover from. The lesson? Parabolic moves driven by concentrated positioning end badly. 2011. Silver hit $49 during the post-financial crisis commodity supercycle. Gold was at $1,900, oil was over $100, and the narrative was print money, buy hard assets. That top came when retail showed up en masse, coin shops had lines around the block, and sentiment went from bullish to certain. The difference between those two psychological states is the difference between a healthy bull market and a bubble about to pop. COVID era, 2020. Silver went from $12 to $30 in 5 months. The catalyst was Reddit's Wall Street bets trying to squeeze the silver market after GameStop. It worked for about 3 weeks. Then reality set in that you can't actually squeeze a globally traded commodity the way you can squeeze a heavily shorted stock. So where does our current situation fit? We're at $106, which is more than double the 2011 all-time high, even without adjusting for inflation. If you adjust 2011's $49 for inflation, you get around $68 in today's money. We've blown through that. We've entered price discovery territory where there's no historical resistance, because silver has literally never been this expensive in nominal terms. Here's the pattern across all those historical spikes. They started with legitimate fundamental drivers, attracted momentum traders, then pulled in retail at the peak. The retail flood is the danger signal. Not because retail is dumb, retail isn't dumb, but because retail shows up late, by definition. If you're hearing about silver from your uncle who doesn't follow markets, you're in the 9th inning. Current data suggests we're in the 7th inning. The SLV volume explosion is the crowd arriving. Short interest disappearing is the bears giving up. Dealers pulling back above $100 is the physical market showing stress. Those aren't fatal signals yet, but they're yellow flags waving in your peripheral vision. The thing about those historical spikes, they had one similarity. Crowd belief turned into crowd certainty. When people stop saying, I think silver's going up, and start saying silver can't go down, that's when you're at a top. We're not quite there yet. There's still debate. Still skepticism, but we're close enough that you need to be managing risk, not just piling in. Here's the second cliffhanger. Every major silver spike has ended with a 40 to 60% retracement within 6 months. Every single one. The question isn't whether we get a pullback. Probabilities say we do. The question is whether it comes from $110 or from $150, and that answer determines whether you make life-changing money or watch your gains evaporate. Here's where we separate position building from event chasing. And this is critical because your psychology determines your outcome more than your analysis does. If you're event chasing, you're vulnerable. The market can smell it. You're checking prices every 5 minutes. You're reading every headline. You're in group chats where everyone's posting rocket emojis. That's not investing. That's gambling with extra steps. And when the pullback comes, not if, when, you're going to panic sell at exactly the wrong time. Position building means you're okay if price drops tomorrow. You've sized your position so a 20% pullback doesn't force you to sell. You've done the research so you understand why you're holding, not just hoping for number go up. You're playing a 5-year game in a market full of 5-day traders. Let me give you 4 questions that separate smart positioning from dumb speculation. Question 1. Based on supply constraints and the mining cost floor at $30, is there a genuine fundamental floor under this market? Answer: yes. Silver's not going to $15. The asymmetry is massively skewed to the upside over multi-year timeframes. Question 2. What does current sentiment look like relative to past tops? Answer: we're hot, but not hysterical. The retail FOMO is building but hasn't peaked. Compare this to 2011 when coin dealers couldn't keep inventory for more than an hour. We're not there yet. Question 3. What's the risk-reward ratio from current prices? Answer: from $106, a move to $135 to $150 over 6 months gives you 25 to 40% upside. Downside to a consolidation at $85 to $95 gives you 10 to 20% risk. That's an asymmetric setup if you can handle the volatility. Question 4. What are the timing signals that suggest imminent continuation or reversal? Answer: watch for 1 to 2 weeks of consolidation above $100. If silver can hold triple digits and build a base, that's bullish for the next leg. If we lose $100 and can't reclaim it within a week, the correction's going to be severe. Here's the framework. If you wait until everyone agrees, you're going to be late. Contrarian positioning means you're buying when there's still skepticism, not when your barber's asking how to buy silver coins. Right now, we're in a middle zone. The early contrarians bought at $70 to $80. The late chasers will buy at $130 to $140 after another parabolic week. You're somewhere in between. The edge isn't in being early or late. It's in understanding which phase you're in and positioning accordingly. If you're building a long-term position, this pullback or consolidation is your friend. If you're trying to catch the last 20% of a move that's already up 400% from the lows, you're picking up pennies in front of a steamroller. For deeper analysis, check the channel membership link below. I do weekly deep dives on positioning, risk management, and market structure for members. The kind of analysis that doesn't fit in a YouTube video but makes the difference between capturing moves and getting run over by them. Now let's get technical for a minute, because while I don't believe charts predict the future, they do reveal crowd psychology and structural levels where behavior changes. Support levels. $106 is holding right now. That's the battleground. Below that, $100 is massive psychological support. Triple digits versus double digits changes the perception of an asset. If $100 breaks, next support is probably $90 to $92, which was resistance on the way up. Resistance levels. $110 needs to be reclaimed to keep momentum alive. That triggers algorithmic buying and brings in the momentum funds who trade breakouts. Above that, $118 is yesterday's high and the level that rejected price. Break through $118 with volume, and you're looking at a run to $130 to $135 with very little resistance in between. Market structure nuances. This is where it gets interesting. The paper market, futures, ETFs, derivatives, is showing extreme activity. That $40 billion single-day SLV volume is paper money sloshing around. But the physical market is showing stress. Dealers pulling back, premiums starting to widen in certain channels. That disconnect is either the beginning of a genuine shortage that drives prices way higher, or it's the warning sign that the paper market's going to snap back to reality and crush leveraged longs. The exchange data shows something concerning. Open interest in silver futures is elevated, but not at extremes. That means there's still room for more speculation to pile in. In 2011, open interest was at record highs when we topped. We're not there yet. That's actually a bullish sign for another leg up, but it also means the eventual correction has more fuel. ETF flows are the tell. When SLV sees massive inflows for 3 to 5 consecutive days, that's institutional and large retail arriving. We just had one explosive day. If it continues for a week, the next phase of the move is confirmed. If it was a one-day spike and flows normalize, we're consolidating here for a while. Let me walk you through the price target logic. Based on the supply constraints, limited ability to increase production quickly, and the demand dynamics, industrial investment and speculative buying converging, the math is probability weighted toward $120 to $135 over the next 3 to 6 months. That's not a guarantee. It's a probability weighted scenario where the fundamental setup supports higher prices if the macro environment cooperates. The path from $106 to $135 looks like this. Consolidation for 1 to 2 weeks above $100 to build a base. Breakout through $110 to $118 on volume. Rapid move to $130 to $135 as momentum traders pile in and stops get triggered on the short side. Then either a blow-off top and sharp correction, or a slower consolidation at higher levels before the next leg. Historical patterns suggest the blow-off scenario is more likely, but market structure can surprise you. Now let's zoom out to the bigger macro setup, because silver doesn't trade in a vacuum. It trades in the context of interest rates, dollar strength, inflation expectations, and risk sentiment. Interest rates. If the Fed's cutting rates or signaling dovishness, that's rocket fuel for precious metals. Lower rates reduce the opportunity cost of holding non-yielding assets like silver. They also typically weaken the dollar, which makes dollar-denominated commodities more attractive. Current Fed policy stance matters enormously. If they're concerned about growth and willing to ease, silver's got a tailwind. If they're fighting inflation and staying tight, that's a headwind. Dollar dynamics. Silver typically moves inverse to the dollar. When DXY is falling, commodities rip. The dollar's behavior over the next quarter is probably the single biggest variable in whether silver hits $135 or pulls back to $85. Watch the dollar index. If it breaks support and trends down, silver's going to run. If it firms up and rallies, silver's going to struggle. Inflation versus deflation. This is the tricky one. High inflation should be bullish for silver as a store of value. But if inflation comes with economic strength, real yields can rise, which is bearish for precious metals. The best environment for silver is stagflation, high inflation with weak growth. That forces central banks to ease despite inflation, weakens currencies, and drives safe haven buying. Risk asset behavior tells you about the macro mood. If stocks are ripping and crypto's going parabolic, risk appetite is high and silver might consolidate as a boring asset. But if stocks start rolling over and crypto's getting volatile, silver becomes a hybrid play. Part risk on speculation, part safe haven protection. That's when you get the really explosive moves. Geopolitical tensions, wars, trade conflicts, government instability, all bullish for precious metals. Silver's unique because it's both an industrial metal and a monetary metal. Geopolitical chaos drives the monetary premium, while industrial demand can stay resilient or even increase in a rebuilding scenario. Here's the pattern. When you see silver showing this kind of meme-like behavior with 3 to 10% daily moves, it's typically because the macro backdrop has multiple bullish drivers converging. One driver alone doesn't create this much momentum. You need a cocktail, maybe dollar weakness plus inflation fears, plus geopolitical stress, plus speculative mania. When that cocktail is mixed, silver can sustain moves that look insane in the moment, but make sense in retrospect. The timeline here matters. This doesn't happen overnight. The 2011 move took about 10 months from breakout to peak. The 2020 move took 5 months. We're probably in month 3 or 4 of the current leg if you count from the breakout above 60-70. That suggests we've got another 2 to 4 months of potential upside before the typical cycle peaks. Not a guarantee, just historical pattern recognition. Credit conditions and volatility indicators. When credit spreads are widening and the VIX is elevated, that's fear in the system. Silver often rallies initially on fear, but can get caught in a liquidity crunch if fear turns to panic. Watch the VIX. If it's below 20, we're in greed mode and speculation is safe. Above 30, people start selling everything to raise cash, and silver can get hit despite being a safe haven. Here's where the edge is, and this is what separates people who capture the meat of the move from people who give it all back. Wall Street analysts are looking at the $40 billion SLV volume day and calling it strong interest or healthy consolidation. They're missing the historical signal. Extreme volume after a vertical move is usually exhaustion, not confirmation. The smart money already positioned at $70-90. The dumb money's arriving at $105. The question is who's selling to them. What the crowd doesn't see yet is the physical market stress. Dealers refusing to buy above $100 is not bullish. It's a warning. It means the bid-ask spreads are widening. It means liquidity is deteriorating despite rising prices. In healthy bull markets, physical dealers are aggressive buyers because they can flip inventory quickly. When they pull back, it's because they smell something wrong with market structure. The overlooked opportunity is this. If silver consolidates above $100 for 1 to 2 weeks and builds a base, that's a gift. It allows late arrivals to position without chasing parabolic price action. It resets sentiment from euphoric to cautiously optimistic. It creates the setup for the next leg. Most people will get scared during consolidation and sell. That's when you want to be buying or holding. The asymmetric setup is the risk-reward from consolidation levels. If silver pulls back to $95, $100 and holds, you're risking $10 to $15 to make $30, $50 over the next 6 months. That's a 2.1 or 3.1 setup. Compare that to chasing price at $115. You're risking $20, $30 to make maybe $20, $35. The math doesn't work as well. Here's the contrarian positioning. Everyone's talking about how high can silver go? Almost nobody's talking about what happens if silver drops 20% in 3 days. That second question is more important because if you've sized your position, assuming silver only goes up, you're going to panic when it drops. But if you've planned for a 20-30% pullback as a normal part of the journey to $150, you'll hold through it or even add. Short interest has disappeared. That's a late cycle signal. Early in bull markets, shorts provide fuel for squeezes. Late in bull markets, everyone's already bullish and there's no one left to squeeze. You need new buyers to push prices higher, and those new buyers are typically the weakest hands, retail arriving late. The leading indicator I'm watching, physical premiums. If premiums on coins and bars start spiking above 20-30% over spot price, that's a genuine shortage signal and bullish. If premiums start falling despite rising spot prices, that's distribution from dealers to retail and bearish. Personal psychology check. If you can't handle 3-day dips, this sector will chew you up. Silver's going to move $10-15 in a session, maybe multiple times. You need to be willing to look wrong before you look right. You need to have conviction based on research, not just momentum. Because momentum works until it doesn't, and when it stops fast. Think of silver like a heavyweight boxer. It lumbers, feints, throws a massive hook when you're not looking, then clinches and recovers. The trader who tries to dodge every little jab gets exhausted. The trader who understands the rhythm and stays patient catches the big right hand that knocks out the shorts and propels price to new highs. Phase 10, Action Framework, 23.25 more. So what does this mean for you? Let's get specific with timelines, levels, and risk management. Short term, next 2 to 4 weeks. Watch for consolidation above $100. If silver holds 110 for a week or more, that's setting up the next leg to 120, 135. If silver breaks below $100 and can't reclaim it within 48 hours, we're likely heading to $85, $92 for a deeper correction before the next attempt higher. Key level to watch, $106 support and $110 resistance. The resolution of that range tells you the next direction. Medium term, next 3 to 6 months. Base case target is $120, $130 based on supply constraints, historical patterns after consolidation, and macro tailwinds. That assumes the dollar weakens, Fed stays dovish or eases, and we don't get a major liquidity event that crushes all risk assets. The path is unlikely to be straight up. Expect at least one 15 to 20% pullback along the way that shakes out weak hands. Long-term, 6 to 12 plus months, ultimate target depends on how deep the mania goes. If silver's move is driven by genuine supply shortages and sustained industrial demand, $150, $180 is realistic over the next year. If it's purely speculative froth, we top out below $140 and spend years digesting the gains. The mining cost floor at $30 means the long-term downside is limited to maybe $50, $60 in a worst-case liquidation scenario. Risk management principles. Position sizing is everything. If you're risking more than 5 to 10% of your portfolio on silver, you're gambling, not investing. Getting paid to wait means you're not stressed about daily moves. You've sized appropriately. You've done the research. You believe in the 5-year case, even if the 5-month case goes against you. What invalidates the thesis? A break below $90 that holds for more than a week suggests the bull market is over and we're entering a multi-year bear. A spike above $150 followed by a 40% drop in less than a month signals a blow-off top and the need to get defensive. The macro environment shifting to strong dollar, rising real yields, and Fed tightening would be a headwind that makes the bull case much harder. Specific stop-loss or reevaluation triggers. If you bought at $105, a close below $95 should trigger a position review. Not necessarily a sell, but a review. Are the fundamentals still intact? Is this just volatility, or has something structurally changed? If silver spikes to $130, $140, consider taking partial profits. Maybe 30-50% of your position. Let the rest ride with a trailing stop. Tell me in the comments, do you think silver hits $135 before March, or does it pull back to $90 first? I'm genuinely curious where sentiment is because that tells me how much upside is left. When everyone thinks we're going straight to $150, that's when I get nervous. When half the comments say crash incoming and half say moon imminent, that's actually a healthier setup. Remember what I said at the start. $40 billion in a single day, volume exceeding an entire quarter from last year, and everyone's asking if this is a consolidation or a top. Now you have the framework to make that determination for yourself. The 3 most important data points. 1. Physical market stress. Dealers pulling back above $100 is a warning, not a confirmation. 2. Volume signature, 15x, normal SLV volume, is exhaustion behavior that typically precedes consolidation or correction. 3. Short interest collapse. When bears capitulate, you've lost the squeeze fuel and you're dependent on new buyers, usually the weakest hands. What to watch for next? Consolidation above $100 for 1 to 2 weeks, bullish for next leg. Break below $100 that holds $100 correction to $85.92, likely. Breakout above $118 on volume, but run to $130, $135, probable. Early warning indicators, physical premiums widening above 30%, genuine shortage signal, bullish. ETF outflows for 3 consecutive days, smart money exiting bearish. Dollar breaking support and trending lower, major tailwind for silver. VIX spiking above 30, liquidity risk that can hit all assets, key price levels that confirm or deny the thesis. $100 is the must-hold level. Lose that, and the bull case is delayed, not dead, but you're going to suffer a painful correction. $110 reclaim and/or confirmation of continuation. $135, $140. Take profit zone where you should be reducing position size and banking gains. The next phase of this cycle won't send you a calendar invite. It's happening now, in real time. While you're watching this video, the market's making decisions. The only question is whether you're positioned to benefit or you're going to be reactive and chase or panic. Positioning happens in the quiet moments, not the loud ones. When silver's up 10% in a day and everyone's screaming about it, that's not when you want to be buying. When silver's grinding sideways for 2 weeks and everyone's bored and talking about other assets, that's when you position. Market's price consensus, not inevitability. Right now, consensus is building toward silver's going higher. That's fine for another leg. But when consensus becomes unanimous, when there's no debate, only agreement, that's when you want to be defensive. We're not there yet. There's still enough skepticism that another move up is possible. But we're close enough that you need to be managing risk, not just hoping for more gains. I'll be tracking physical premiums and ETF flow data closely. That's the tell. If premiums spike and ETF inflows continue, we're in the beginning of a genuine mania and you want exposure. If premiums fall and ETF flows reverse, the top's probably in and it's time to take profits or reduce size. 3 quick things before you go. First, hit subscribe so you don't miss the next move. This channel covers silver, gold, macro, and contrarian investment strategies that actually work. No hype, no BS, just analysis based on market mechanics and historical precedent. We're building a community of people who think independently and position accordingly. Second, share your success story in the comments so others can stay motivated. Did you buy silver at $70 and you're sitting on massive gains? Tell us. Did you get shaken out at $95 and regret it? Share that too. The comment section here is where we learn from each other's experiences. I read every single comment and I respond to most of them. Third, join my premium WhatsApp channel for daily voice notes and instant updates. Link in description. When major market moves happen, I send out immediate analysis. You get real-time positioning ideas, risk management alerts, and the kind of tactical information that doesn't wait for a full YouTube video. It's for serious investors who want to stay ahead of the curve. And we're doing a giveaway at month's end for subscribers who comment. You're automatically entered just by engaging. Details in the description. Before I go, legal disclaimer, because YouTube makes me say this. This is not financial advice. I'm sharing my analysis and opinions for educational purposes. Do your own research. Consult a qualified financial professional before making investment decisions. You're responsible for your own trades and positions. Silver's at an inflection point. The next 2 weeks determine whether we're building the base for a move to 135 plus, or whether we're topping out here and heading for a correction. Either way, there's opportunity. The question is whether you're positioned with a plan or you're reacting emotionally to every $5 move. I'll see you in the next one.